Hi, and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's see the analysis.
$1.30.
Mm-hmm.
That is exactly where Zeo Energy Corp, ticker ZEO, closed trading on February 20th, 2026. And, that represents a single-day appreciation of 31.63%. But if you just look at the price, you're missing the actual signal here.
You're talking about the volume.
Exactly. The volume hit 2.41 million shares. That completely eclipses the 90-day average of, roughly 378,000. We saw intraday volatility of over 40%. It was swinging from $1 flat all the way up to 142.
Right.
The market just woke up.
And yet, if you zoom out just a little bit, which I always suggest we do when things get this heated, we are looking at a stock that is still down nearly 87% from its all-time high.
Sure, historically speaking,
it is trading well below its trailing annual mean of $1.71. So, you see a wake-up call. I see a classic dead cat bounce on massive volume.
But the question isn't where it has been, it's where it is going. The debate we have to settle today is whether this volatility is a legitimate pivot bottom. A market recognition that Zeo is successfully transitioning from this struggling residential solar installer to a critical player in AI data center infrastructure. Or, on the flip side, are we looking at a bull trap? I am arguing that the market is finally pricing in a fundamental structural shift in their business model.
And my position is that while the narrative is intoxicating, and I admit, look, everyone loves an AI pivot story right now, the fundamentals reveal a cash-poor company. They are relying on non-binding agreements and a financing facility that looks, frankly, suspiciously like a dilution spiral. You are buying a story. I am looking at the balance sheet.
Well, let's unpack the story then, because it is not just hype. Zeo Energy has positioned itself at the intersection of arguably the two most significant trends in the modern economy: decentralized energy generation and the absolute explosion of power demand for artificial intelligence.
Two very expensive trends,
But highly lucrative ones. And the catalyst for this recent price action isn't some mystery. It is the February 18, 2026 Memorandum of Understanding with Creekstone Energy regarding the Utah gigasite.
Memorandum of Understanding. I really want to put a pin in that phrase because we are going to need to dissect what that actually means legally.
It is a standard first step, and this isn't just another solar farm. This is a plan to develop 280 megawatts of baseload energy for a project that has a long-term target of 10 gigawatts.
I see why you emphasize the scale. 10 gigawatts is massive. But we have to look at the terminology of that MOU. It is non-binding. It is a handshake. It is a press release about a plan to make a plan.
It initiates a pre-feasibility study. It puts them in the room. And here's why it matters. And this is the key insight for anyone watching the energy sector right now. The U.S. grid simply cannot handle the projected 150 gigawatts of IT load capacity we need by 2028.
Yeah, the grid is constrained.
Severely. We are seeing data center developers bypassing the utility grid entirely. So Zeo's acquisition of Heliogen allows them to solve the firm baseload problem for high-performance computing.
Okay, let's define firm baseload for the listeners because that is the buzzword doing the heavy lifting for your argument here.
Sure. So solar panels are great, but obviously they stop working at night. Data centers need to run 24/7. Firm baseload means power that is always on. Usually, historically, that's coal, nuclear, or gas. But Zeo is using Heliogen's technology, which is concentrated solar power coupled with thermal storage, to provide green energy even when the sun isn't shining. The residential revenue they have is stabilizing and providing a floor, but this industrial pivot, that is where the alpha is.
I come at it from a totally different angle. You see alpha, I see a balance sheet that is flashing red. Let's look at the actual numbers as of September 30th, 2025. Zeo had just $3.9 million in cash and cash equivalents.
Right, but
And in the third quarter alone, they had a negative free cash flow of $6.8 million. Just do the math. You cannot build gigawatt-scale infrastructure or even finish the paperwork for it on $4 million of cash when you are burning almost $7 million a quarter.
They have financing mechanisms in place, which we will absolutely get to.
We certainly will. But my position stands that Zeo is fundamentally capital constrained. The excitement about the Creekstone deal obscures the harsh fact that Zeo is required to perform pre-feasibility studies and front-end engineering design. That costs real money. They are burning cash to chase a contract that isn't guaranteed. And regarding that financing mechanism, the White Lion Capital Facility, I view that not as flexible funding, but as a mechanism for dilution. They are selling shares just to keep the lights on.
That is a very harsh characterization of what is a fairly standard equity line. But let's dig into the core debate here. The market is reacting to the technology because the problem it solves is existential for the AI industry.
If the technology works, and if they can afford to deploy it.
Let's talk about the technology then. The Heliogen acquisition in August 2025 was the turning point. Traditional PV solar is intermittent. You cannot run a data center on it without massive battery backup, which is cost prohibitive for long durations.
Right, because to bridge the night, you need, 12 to 14 hours of storage?
Exactly. And lithium-ion batteries are fantastic for 2 hours, maybe 4. But for 14 hours, the unit economics are destroyed. The CapEx is just too high if you have to replace those batteries every 7 to 10 years. Heliogen's technology uses computer-guided mirrors, heliostats, to reflect sunlight onto a single receiver tower. This generates high-temperature heat that is stored in ceramic particles or molten salt. It acts like a massive thermal battery.
I have to interrupt because I just don't buy that this is a solved problem. We have seen this movie before with concentrated solar power, or CSP. Look at Ivanpah in California.
Ivanpah was a very early iteration.
It was a disaster. High-profile failures, massive cost overruns, and they were literally incinerating birds in midair because the beams were so hot. Even Heliogen, before Zeo bought them, halted their Capella project in Texas in late 2024. They stopped construction due to costs. Why should we believe that Zeo, with less capital than Heliogen had, can make this work?
That is a fair historical point, but I would frame it differently. The failure of early CSP projects like Ivanpah was largely due to the sheer size and complexity of those massive towers. It was like trying to build a bespoke, custom skyscraper every single time. Zeo's strategy with the Heliogen tech is modular. They are focusing on 5-megawatt units.
So just smaller towers?
Exactly. Think of it less like a skyscraper and more like a Lego block. You reduce the capital risk significantly compared to the billion-dollar mega towers of the past. And you have to look at the storage medium. Thermal storage in ceramic particles is purportedly 100 times less expensive than lithium-ion batteries.
Purportedly is doing a lot of heavy lifting there.
It is just physics. Dirt and salt are cheaper than lithium and cobalt. When you're talking about the need for 10 to 15 hours of storage to run a data center through the night, batteries destroy the P&L. Thermal storage makes 24/7 renewable power actually viable. That is the competitive advantage.
Complexity often requires multiple perspectives. So let's look at the execution risk of that technology. You are talking about a first-of-a-kind deployment for this specific modular configuration at this scale. Even if the physics of the storage medium are sound, and I grant you hot sand is cheap, the engineering reality of keeping those heliostats aligned and the receiver operating efficiently is incredibly difficult, and they have to do this while bleeding money.
But that is exactly why the Utah Gigasite is the perfect proving ground. It's a 280-megawatt carve-out in a massive project. If they can prove the levelized cost of storage is lower than batteries, they become the partner of choice for Amazon, Google, Microsoft. The total addressable market is 1,000 terawatt-hours by 2030.
I agree the market is there. I vehemently disagree that Zeo is the vehicle to capture it. Which brings us back to the money. You mentioned the White Lion Capital Facility earlier. Let's really drill down on that $30 million common stock purchase agreement they signed in January 2026.
It provides vital liquidity. It allows them to draw capital when they need it to fund these studies without taking on toxic, high-interest debt.
It acts as a committed equity facility. Yes, Zeo has a right to sell shares to White Lion, but the pricing is tied to recent market trades. Here is the trap, and I want listeners to really visualize this. It is a death spiral risk.
Death spiral is quite dramatic.
It is mathematically accurate. If Zeo needs $1 million and the stock is at $2, they sell 500,000 shares.
But if the stock drops to $1, they have to sell 1 million shares to get that same $1 million in funding. The lower the price goes, the more shares they have to print, which dilutes the existing shareholders and pushes the price down even further. It becomes a vicious feedback loop. They are diluting the existing shareholders to fund the study for a project that might not even happen.
I see the risk you are pointing out, but you are assuming the stock price drops. The counter-argument is that this facility is merely a bridge. It bridges them to the point where they can get project-level financing. Zeo's financing arm has a history of securing tax equity investments, over $44 million historically.
Explain tax equity for a second, just so we are completely clear on the mechanics.
Essentially, the government offers tax credits for green energy projects. Zeo can sell those credits to a bank or a large corporation that has a big tax bill. The bank gives Zeo cash to build the project, and in return, the bank gets to lower their taxes. Zeo doesn't need to fund the construction of the gigasite off their own balance sheet. They just need to fund the engineering to get to the notice to proceed. Once they have that, the big money steps in.
And while they attempt to cross that bridge, insiders were selling. Brandon Bridgewater, the CSO, sold shares in December 2025 at the 1.15 to 1.20 level. If the insiders were selling at the bottom, right before this supposed pivot, why should retail investors buy the rip?
I am not convinced by that line of reasoning, because the volume of selling was minimal relative to their overall holdings. You have to look at the entire ownership structure. Insiders, including the Bridgewaters, still hold approximately 70.9% of the company. That is massive alignment with shareholders. A few sales for tax purposes or liquidity after a lockup period doesn't negate the fact that their net worth is heavily tied to this stock going up.
70% ownership also means the public float is tiny.
Which completely explains the volatility we saw on the 20th.
Exactly. It doesn't take much volume to move the stock 30%. It works both ways, as you said. But let's look at the core business, because you mentioned earlier that they have a stable floor, but they are bleeding cash.
In Q3 2025, their gross margins improved to 57.4%. That is up 860 basis points year over year. The residential solar business is becoming significantly more efficient. They are verticalizing, cutting out the middlemen sales organizations, and expanding into broader energy efficiency, like HVAC and smart homes. This isn't a dying business. It's a stabilizing one that provides the runway for the AI moonshot.
Stabilizing revenue is not the same thing as profitability. The net loss for the first 9 months of 2025 widened to $17.9 million. Yes, Q3 revenue was up, but they are still digging a hole. And frankly, the residential solar market is highly sensitive to interest rates. If rates don't come down as fast as predicted in 2026, that stable floor you mentioned could completely fall out.
That is a fair point on interest rate sensitivity. But let's talk about the valuation potential. The moonshot. Can this stock 5x?
That is the dangerous question every retail investor is asking right now.
The math suggests it is absolutely possible. A 5x return implies a market cap of roughly $300 to $375 million, or about $6.50 a share. How do they get there? They have to shift the revenue mix. Right now, they are primarily an installer, which is low margin. The Helio model is about licensing and engineering, which is high margin.
That is the software multiple argument applied to a hardware company. You want them to trade like a SaaS company while they are out there pouring concrete and building mirrors.
Exactly. If the Utah Digasite works, if they successfully deploy that 280 megawatts, it validates the entire model. Suddenly, Zeo isn't a regional solar installer. They are a technology licensor for the 1,000-plus terawatt-hour global data center demand. A $300 million market cap for a company solving the primary power constraint for AI is actually conservative if the tech works.
If. That is a 2-letter word doing an incredible amount of work in your thesis. I acknowledge the math, I really do. But I question the probability. The execution gap between a non-binding MOU and a definitive engineering contract is where microcaps usually die. They need to survive the trough of the residential solar cycle before they can ever realize these AI gains.
But look at the technicals. We saw a pivot bottom form on February 5th. We have a potential double bottom pattern targeting 250 in the medium term. That is an 80% gain from the December lows. The market is sniffing out this opportunity.
Relying on technicals for a low-float, highly volatile penny stock is like reading tea leaves in a hurricane. You cannot rely on chart patterns when a single rapid purchase notice to White Lion can flood the market with new supply.
But that supply is only a risk if the demand isn't there to absorb it. And the demand for the story is building. The IEA projects data center electricity generation to hit 1,300 terawatt hours by 2035. That is a 22% annual growth rate. Zeo is the only small-cap pure play I know of that combines residential distribution with utility-scale thermal storage. It is a high-beta, pick-and-shovel play.
It is certainly high beta. But let's talk about the dilution math again. The Heliogen acquisition already added about 6.3 million shares. The White Lion facility adds more. For the stock price to 5x, the enterprise value has to grow significantly faster than the share count. If they double the share count just to stay alive over the next year, the company could be worth twice as much inherently, and the stock price stays completely flat. That is the dilution trap.
But if they secure project financing for Utah, the dilution stops. The White Lion facility is an insurance policy. It is not the primary funding plan. The primary plan is project debt and tax equity, which the market will welcome with open arms.
Project financing requires a bankable feasibility study, which brings us right back to the current burn rate. They have to spend the money they don't have to prove the project they haven't signed is viable. It is a classic chicken and egg problem.
And that is exactly why the risk-reward is asymmetric. If they solve the chicken and egg problem, you don't get a 20% return, you get a 500% return.
Or you get zero.
I think zero is highly unlikely given the residential asset base. They expanded into Virginia, California, Colorado, Utah via the Lumio asset acquisition. There is real tangible value there.
Assets acquired from distressed entities often carry massive integration risks. And again, residential solar is a tough, low-margin grind. It is not the engine that gets you to 6.508 a share.
No, but it keeps the engine running while they build the new one.
Barely running.
Let's bring this to a close. I look at Zeo Energy and I see a company that has recognized the winds of change. They saw the solar coaster ending and they pivoted hard to AI infrastructure. The Heliogen tech, if it works, is a holy grail for green baseload power. The risk is real, absolutely, but the confluence of stabilizing residential cash flows and the massive, uncapped potential of the Utah gigasite makes this a speculation worth taking for a distinct portion of a portfolio. The double bottom suggests that technicals are finally aligning with this fundamental catalyst.
And I maintain that hope is not a strategy. Until that Creekstone MOU becomes a binding contract, a definitive agreement with actual cash attached, and until the company demonstrates it can raise capital without hitting the bid on the White Lion facility, this stock remains a gamble, not an investment. Investors should not watch the flashy AI headlines. They should watch the White Lion notices. That is the real price action. If you see accelerated purchase notices, run.
And I would say if you see the notice to proceed on the Utah Giga site, buy.
Well, we can agree on one thing. The next 6 months, specifically the outcome of this pre-feasibility study, will absolutely determine if Zeo is a zero or a hero.
Absolutely. The clock is ticking.
Indeed it is.
If you like this video and want to watch more content like this, don't forget to subscribe. Thanks for watching. See you.